Joining us right now, Chief Market Strategist at B. Riley Financial, Art Hogan. Art, good to see you. Thanks very much for joining us. Any impact from this hurricane on commodities, on markets? What's your take?
Yeah, we've certainly seen an impact. There's going to be some shut-in capacity coming out of the Gulf, so we're already trading about $75 in WTI. Nat gas is actually catching a bit as well. Obviously, that commodity's been up quite a bit over the last couple of weeks, but I think that in general, anything that takes some of the supply offline for a period of time, and this could be a week, not a couple of days, is going to increase commodity prices. I think the larger impact is going to be the things that we normally see, like Bob would talk about at Home Depot, the kind of traffic you see in preparation for and then coming afterwards and getting things repaired. So I think you see a lot of traffic in generators. You certainly see plywood, all those things that happen at Home Depot. And then the follow-up is, all the things you have to replace. So I think this is going to have an economic impact, and it's increasing in magnitude. It's not decreasing. So I think.
Meanwhile, the big story for markets has been the 10-year Treasury. Obviously, that's been unnerving stocks now at a 7-year high. Are you worried about that?
No, we get worried when it happens quickly. So the 20 basis point move that you see in a week is a lot faster than you typically see generally in fixed income markets. And that same thing happened back in February. That first week of February, we saw a 27 basis point move in the 10-year, and markets went down, and the S&P 500 went down about 8.6%. I don't think we're going to see that same kind of reaction. I think it'll stabilize. I think the new normal in the yield on 10-year is somewhere between 3 and 3.30. The problem is when it's happening that quickly, when we get 20 basis points in a week, the market assumes we're going much higher, and I don't think we are. I think we're probably, in a rising rate environment, but I don't think it's going to be something that's going to necessarily slow down the economy or slow down earnings.
Yeah, so Art, to that point, to stay with it, the president's kind of looking at the Fed saying that's what's caused the downturn in the equities market. You've been labeled the expert in the equities field. So is it the Fed rate having that negative impact while the economy's still moving along pretty darn well right now? A lot of people are projecting 3.7% growth through 2019.
Yeah, no, I don't think the Fed is doing anything that the president's not doing, and I think they're both leaning against a strong economy to accomplish something that they need to do. The Fed needs to normalize rates so that we're at a place in 2020, if things were to slow down, they'd have something to give back. I think that, the president is leaning against a very strong economy to get things accomplished on trade. Unfortunately, when it seems like they're at odds with each other with, very aggressive fiscal policy and normalizing monetary policy, I think both sides are going to be fine. I think that this is a Fed that's been very gradual. We keep talking about how much they're raising rates. They really started in 2015, so it's not as though we're off to the races. I think next year is going to be completely different for the Fed, and I mean that by the fact that next year every Fed meeting is going to have a press conference at it. So every Fed meeting is live. This year we think, okay, it's once a quarter when we get that press conference. So as we said, it's September, there'll be one in December. Everything changes next year, and I think that changes the way the Fed thinks about the pace of monetary policy. And I think that if they see anything like a flattening yield curve or a slowdown in Europe, they'll probably slow down themselves.
I don't know why the president keeps taking aim at the Federal Reserve, really. He argues again that the central bank could be raising interest rates more slowly. Here's what he said to reporters yesterday before boarding Marine One at the White House.
The Fed is doing what they think is necessary, but I don't like what they're doing. The numbers that we're producing are record-setting. I don't want to slow it down even a little bit, especially when you don't have the problem of inflation and you don't see that inflation coming back. Now, at some point it will, and you go up. I just don't think it's necessary to go as fast.
Wow. Dagan, what do you think about that?
Why is he talking about the Federal Reserve? Because President Trump's going to talk about whatever he wants to talk about, quite frankly.
True, yes,
number one.
Yes.
And number two, the most important thing is President Trump said he has not spoken with Jay Powell about his concerns because, quote, I like to stay uninvolved with that. That's the most important thing that you need to know is that he's jawboning about it. And he should know, though, that the Federal Reserve, the FOMC, is more likely to be a little bit more aggressive if you keep talking about the Fed being accommodative. Steve has his response written all over his face.
What do you want to say?
No, I think getting interest rates back to normal is a good thing, and that's not what's weighing on the economy. I'd love to get Art's opinion. How much of trade? Everyone sort of assumes we're going to resolve China the way we did Mexico, Canada, maybe Europe. If that goes the wrong way, what is going to happen to the market and to the economy?
I think that's the best question of the day when you think about what are markets really concerned about, and it's not the Fed and what they're doing to rates. I think markets are concerned about how big trade concerns get. So right now we're at a very manageable level with what we've already put forward with China. When you think about the drag on the economy, it's about $35 billion in a $17 trillion economy. So that's really manageable. But if we go the whole way, if at the turn of the calendar we go from 10% on $200 billion worth of goods to 25%, and then escalate that to the whole Megillah and have $467 billion worth of goods where we have a 25% tariff on that gets into real numbers. You're about $150 billion in drag on the economy.
And then the big thing is profit margins.
Exactly, and input cost. We're going to find out in this earnings reporting season from conference calls just how much it's already started to affect companies, whether it's in steel, aluminum, any kind of input prices. And I think the administration will take notice of that when they start hearing companies saying, we have to give you difficult guidance, or we're going to be subdued about our guidance going forward because we're not really sure what our profit margins look like because of the input costs.
But they've been hearing that from these companies, though, probably indirectly. Their individual CEOs have been fussing at the White House, quite frankly, the ones that have been hurt by these, specifically the steel and aluminum tariffs, and they're not budging.
But now we'll actually get the guidance in terms of the impact. Yeah. But you're right. I mean, companies have already reached out to the president.
A lot of the companies are saying they can handle the 10%. Steve and I were discussing. They think they got pricing authority of about 2.7. They think the suppliers out of China will take their prices down versus lose the volume. They think they can handle 10. 20, as you point out, is another issue, huh?
Yeah, I think that's what it is, and we're hoping we don't get there. To Steve's point, is this very much like North America? Are we going to threaten until we get to the things that we want? And is that this year's business, or do we have to wait till next year? I was under the assumption that, very much like Steve just said, that once we get North America right, then we immediately get to the negotiating table with China. It doesn't feel like that's what's happening right now. It feels like the rhetoric is increasing.
China will go on a long time. The fight with China.
Do not think that the trade fight with China is going away.
But because they won't change their behavior and they won't even admit that they're stealing IP.
Right. And how about that speech that the vice president gave last week outlining what we're going from engagement to confrontation with China? And then you had Mike Pompeo had gotten to a tiff, if you will, with the foreign minister in China on his visit to Beijing. So there's a lot going on there. And those tariffs are not going away.
No, they're not, because it's not just an economic issue, it's a national security issue.
Absolutely.
So that continues. I mean, I wouldn't expect that to turn around anytime soon. Having said that, the rest of the world is lining up with the U.S. going against China. Yes. Real quick. We're on the doorstep of third quarter earnings. Would you put new money to work in this market here right before we get the bank earnings on Friday and the third quarter in full next couple of weeks?
That's such a great question. This earnings season is happening at a place where stocks are sitting on support, not up at resistance. And I think that's a very good place to be. So if you think about financials, I think they're in a very good place. A rising interest rate environment. They haven't done anything for the whole year. I think in front of the banks is the end of this week you can get in there. I also think energy and healthcare are the three sectors that are going to outperform.
What about semiconductors?
Semiconductors a very cyclical business, very difficult things going on right now. And the combination of semiconductors and social media stocks have been a drag on technology for about 3 weeks. I think, we're overdoing it on the downside in semiconductors. The cycle's certainly not over, and you and I aren't done buying these things and all the other things that we need to, keep going. So I think that, it's a cyclical business, but I think they're going to be fine. But we always shoot. The pendulum has swung too far in the wrong direction on the semis and probably on the social media stocks too.
Art, it's great to have you on the show.
Good to see you.
Thanks so much. So good to see you. Art Hogan joining us there.